Sets us up well for this conversation. Andrew Freris joining us, CEO at Ecognosis Advisory this morning. Andrew, very good morning to you. Andrew, do you believe that given the possibility of rate cuts going forward, do you still believe that markets seem to have overpriced the kind of rate cut which could potentially come through? What's your view? And is that one of the reasons why we could possibly see a bit of a correction, and how much of a correction? I know you are bearish on US equities. How much of a correction are you penciling in?
I love your expression correction, and also in the same way I love the expression rotation. People are absolutely reluctant to say prices are going to fall. There's nothing to rotate about, neither there is to correct. If it corrects, then presumably all the time they were previously wrong. So if they correct, that's a very good thing to happen. Anyway, what concerns me is that the interest rate cut last week was taken on the basis of information as late as September. The Fed doesn't have numbers for October and November for inflation and labor markets. This is insane to cut interest rates on the basis of September figures, all of which show inflation accelerating and the labor market, with 3 negatives and 2 positives, or was it the other way around? 2 positives and 3 negatives. How can the Fed possibly seriously cut interest rates without having data? I don't understand. So the idea that we're going to see, we can look forward to further cuts in interest rates is completely unfounded on any information. Is unfounded on, well, let's keep our fingers crossed. So, you know, I'm profoundly unhappy about that, but there's very little you can do. And as far as rotation and correction is concerned, I repeatedly hear information from other people that potentially know a great deal better than I do, and that is that the AI inflated the Magnificent Seven stays very much. We had the results from Oracle, okay, that were in general poor and also shocked the market because apparently these guys continue to spend on capital without any backing of future expected returns. So if one looks at the position of what should I do, is get out of the index before it falls. What's there to wait anymore? So I'm sorry, you say that I'm negative on equities, on American equities particularly, and on the technology and AI equities. Yeah, I continue to stay so. And the cut in interest rates last week, didn't do anything to make me feel better. It was done literally by flipping a coin and keeping your fingers crossed that things are going to be all right when we have the October and the November numbers.
Andrew, hi, morning. This is Nehi also joining in. Very interesting take coming in. You know what really interests me further is the comment coming in from Trump, wherein he's saying rates should come down as low as 1% amid a lack of data. What do you have to make of that, and what are your expectations for the CPI number that we're expecting to see in the middle of this week?
Well, I'm afraid if you're telling me to pass comments on what Trump says on interest rates, it is like taking candy from a baby. It's very easy to be dismissive. It's very easy to be rude on poor Trump. But he's famous for insisting of cutting interest rates because it suits him, not because the data point this. So, you know, let's leave it aside because it doesn't add anything. What I'm expecting is when we finally get the November and October numbers, I have a terrible feeling that inflation will not have come down. Might not have accelerated, but remember, you have the important 3 numbers, CPI core, and the PCE that the Fed likes, and all of them have got the number 3 in front of them, as opposed to the number 2 and falling. It is not good news. So the Fed decided inflation doesn't matter.
Andrew, if you can also give us a sense of how the trade will shape up, given the fact it's a heavy data week this week. Actually, you have the payrolls data which is coming in, then you have the October retail numbers, and followed by on Thursday a CPI number which comes in, and then to top it all, by the end of the week you have the Bank of Japan meeting, which is expected to raise interest rates further after a long time actually. So how do you see trade, New York reacting to this kind of data-heavy week?
Well, thank you. You're asking me such a lovely question because whatever I'm telling you, I'm going to be proven right. In other words, if the numbers of inflation are up, it's bad news for the Fed. If the number of inflation are down, it's good news from the Fed. So I'm afraid that I'm going to be right either way. As I've told you, I think inflation is going to surprise negatively. Okay, the labor market also, we have to remember that the labor market in the States, particularly when we come to look at non-agricultural, non-farm roles, non-farms jobs moving, are notoriously unstable, and they can be changed and adjusted massively. So I would need at least 3, if not 6 months of unadjusted numbers to feel comfortable to say, look, the labor market is getting worse or the labor market is getting better. So whatever we're going to get is not going to be something that is going to justify what the Fed has done. Unfortunate. Now, the market that I am particularly looking forward to get some data, and we already started getting some, it's China. We already have retail sales, not good. We already are having investment, not good, meaning that the numbers continue to go down. And the prices of property, both new and second-hand property, continues to fall, not to increase slowly, okay, or not to increase at all, continues to fall. The majority of the major housing indexes in China have been negative for nearly 2.5 years. That's a long time to see property prices coming down. I don't gloat at all. The Chinese economy has an underlying strength, okay, which is perfectly okay, but at the same time, one has to explain how it has continuous deflation. It's a very strange combination of events. So the man from Mars could look at China and says, what's their problem? They're having GDP growth that varies between 4.5% and 5%. That's great. And they don't have inflation. Why are they complaining? Well, they are complaining, of course, not because they don't have inflation, because they're having effectively deflation. They're having prices coming down.
Andrew, let me try and get a sense from you. There's been an everything rally. Pretty much all asset classes have done very well through this last 1.5 years, at least on the global side of things. When do you expect to cool off, and which asset classes will likely outperform over the next 12 months, which is calendar year 2026?
I'm going to take a deep breath and I'm going to repeat something which is not at all novelty. You know, precisely because everybody expects the AI boom to deflate, okay, expects to deflate, and they are presumably waiting what? They are waiting for it to deflate. If they get it, they would have got it wrong. They have to get out now. So, you know, I cannot possibly sit down here and tell you, well, really, I think in the next 3 months or sometime on April the 28th at about 3 o'clock in the morning, okay, the AI would deflate. This is absurd. Nobody can predict that. But since there is a continuous fear that this is going to happen, what's there to wait? There are quite a lot of other areas, quite a good sectors, okay, to invest. And I'm sorry, I'm going to repeat that. The defense sector has been doing extremely well. So why stick on artificial intelligence with a lot of very negative trends in terms of huge capital expenditure on the basis of effectively zero knowledge about earnings that is going to justify that, and carry on thinking, well, we'll hope for the best. Go on for something better. The majority of the I'll say that again, the European Union stock index, okay, has been performing very well. There is a number of European countries, actually collectively, that they are doing much, much better than the Standard & Poor index has been doing, as has South Korea, Taiwan, even the Singapore index has been doing quite well. Well, you know, why stick with an overinflated S&P where other things are doing well and they don't have a good reason not to do well? Now we are getting India also with an amazing expression of interest saying India is unrelated to artificial intelligence, is relatively low correlated, there are no major Indian companies in the Sensex that are related or connected to artificial intelligence. And since artificial intelligence is likely to go down, India is an excellent, if you want, kind of safety from the hazard of artificial intelligence. I find this a very interesting suggestion, although you are buying India not because it is good, but because it's unrelated to AI. We live in a very strange world, aren't we?
Absolutely, Andrew. Really appreciate you joining us this late. You're joining us live from London, so really appreciate you coming in and speaking with us, giving our viewers that perspective.